Let's dive straight into a massive opportunity sitting right under the market's radar. Today, we're breaking down a deep dive equity research report on Versigent. We're going to look at exactly what this newly independent company does, why Wall Street is watching it like a hawk, and what the raw data tells us about its underlying value. So, let's get right into it.
I want you to look at this number right here, 59%. According to the research, that is the literal upside potential we're looking at. We're talking about a target price of $74 a share compared to where it sits right now at just over 46. That's a huge curiosity gap, right? So where exactly is that 59% coming from? And more importantly, what actually has to happen for us to see that reality?
To figure that out, we're going on a quick due diligence journey. We'll start with the investment summary, look at their market positioning, dig into the financial performance, address the business risks, because there are always risks, and finally, wrap up with the valuation.
Okay, starting with part 1, the investment summary.
The entire foundation of this thesis kicks off on a very specific recent date, April 1st, 2026. That is when Versigent officially spun off from Aptiv's electrical distribution systems. Now, why is that a big deal? Because it totally eliminates what we call the conglomerate discount. Versigent is now a pure-play, independent beast. Management can finally funnel all their capital directly into their own niche without having to fight for resources inside a massive corporate umbrella.
The bullish case here really leans on 5 core pillars. First up, defensible leadership. They're sitting on roughly a 10% market share, and their tech is in literally 1 out of every 6 vehicles on the road. Second is growth by content. They aren't just crossing their fingers that people buy more cars. Modern vehicles simply require way more electronics and ADAS systems. Third, we've got significant operational improvements mapped out. Fourth, a practically bulletproof balance sheet with a totally manageable $239 million in debt. And fifth, the post-spin re-rating, which is essentially the market waking up and properly valuing this new standalone entity over the next 6 to 18 months.
Moving on to Section 2, Market and Positioning.
Take a look at the structural driver going on here. While the high-voltage EV segment actually dropped by 7.1%, low-voltage electronics, which, by the way, makes up a whopping 90% of Versigent sales, surged by 11.3%. So what's the takeaway? This growth in traditional electrical systems and connectivity acts as a massive shock absorber. It's actively protecting the company from the volatility and the heavy slowdowns we're currently seeing in the broader EV market.
On top of that, this business is insanely sticky. Because they co-designed early with original equipment manufacturers, Versigent's tech is hardwired into vehicle platforms from day one. Trying to rip out and replace a critical system mid-cycle, the technical risk is just huge. Add in a global footprint spanning over 25 countries, and you've got some massive barriers to entry. Now, the report does impartially note that it is still a highly competitive and labor-intensive space, but those switching costs absolutely build a very formidable moat.
All right, Section 3, Financial Performance.
Look, as professional investors, we need hard proof that a spinoff is actually working, right? And when you look at the financials, despite a ton of accounting noise, we're talking heavy one-time separation costs and European plant restructuring. Their adjusted EBITDA is actually trending up. They're targeting a midpoint of $990 million by 2026 with a 10.7% margin. This really proves that the underlying business engine is humming along perfectly, completely separate from those messy temporary spinoff expenses.
The revenue engine is also incredibly well diversified across the globe. North America takes the biggest slice, at nearly 41%. But the real hidden gem here? Asia Pacific. It makes up a third of their sales, but it's driving a phenomenal 16.2% regional growth rate. That geographic spread is absolutely vital, so they aren't totally held hostage by the ups and downs of a single economy.
Let's pivot to Section 4, Business Risks, because no good analysis ignores the threats.
And here is the 80% sized elephant in the room. Roughly 80% of all Versigent sales are tied up in just their top 10 clients. It gets even crazier. Almost half of their entire revenue relies on just their top 3 clients alone. That is undeniable, highly material concentration risk. No two ways about it.
But to be fair, the research report does balance these structural risks against some strong mitigants. Yes, that client concentration could mean a brutal revenue hit if they lose a contract. But again, those long platform life cycles and massive switching costs make it incredibly painful for clients to jump ship. There's also the constant threat of OEMs squeezing them for lower prices, which Versigent fights off by embedding more and more essential engineering value. And of course, there's the risk of spin-off cost overruns. Management's play there is a strictly isolated, highly controlled transition plan to keep those costs in check.
Which brings us to the ultimate question you should be asking management if you're looking at this stock. When exactly are those committed savings going to show up in the margin and the cash flow? Because promises on a slide deck are great, but the market demands to see the actual execution of those savings hitting the free cash flow, period.
Finally, Section 5, Valuation. Let's talk numbers.
We are looking at a deeply asymmetric risk-reward setup here. Let's break it down. In a favorable scenario, where management actually delivers on their guidance, separation costs normalize, and they outpace general auto production, boom, we hit that glorious $74 a share target. On the flip side, in an adverse scenario where volume slows down, price pressures mount, or they drop the ball on efficiency, well, the conglomerate discount basically sticks around and the stock stays depressed. Hitting that upside completely depends on flawless execution by the management team.
So what's the actual math driving that $74 target? The discounted cash flow model is running on a pretty conservative 12.9% weighted average cost of capital and a long-term perpetual growth rate of just 2%. That math alone justifies the 59% leap. And here's the best part. While you wait for this whole thesis to play out, you've got a solid margin of safety. Between a $250 million authorized share buyback and a 13-cent quarterly dividend, you are essentially getting paid to wait for the value to unlock.
At the end of the day, it all boils down to one major mechanical challenge. Can management safely execute this massive spin-off restructuring without breaking their daily operations? If you believe they can pull it off, the math says there is a whole lot of value being left on the table right now. Thanks so much for hanging out with me for this analysis, and I'll catch you in the next explainer.